We're live here with Kelly. I'm excited to have him on here today to talk about financial planning or financial advisory and all that kind of stuff. So I guess from an introduction from my standpoint is I met Kelly sometime around 2004, 2005, around the time when I moved to Moncton, changed corporate jobs. I had an old pension, I guess, investment that I wanted to carry forward. Kelly was referred to me, so we kind of gave him that, and we've been working together ever since. So I trust Kelly, love his information, love his mindset and his philosophy, and he's a home-based business, which is we're going to check the box there, right? So in all honesty, Kelly, man, I've learned a lot from you, even when it comes into, some of the content that I wrote in my book.
Yeah.
Let's call them tax secrets, if you, whatever you want to call them. Like these were coffee chats and lunches that we've had over all the years. Like I've been a sponge for decades, right?
And learning and learning. That's good.
So, and applying the information. So the reason why I wanted Kelly to come in here, I'll let him introduce himself, but in chapter, I think it was 7 and 8, 8, 9, and 10 in the book, I called it tax deferral investments versus tax write-offs, which is, your home expenses and all that kind of stuff. And then what you should do with your tax refund. And I want to kind of dig into that one a little bit because I see a lot of people that I work with in a home-based business that end up claiming their more write-offs, getting a tax refund from their employment income. And the question is, okay, what are you going to do with that money? So maybe Kelly, you can start off and just tell us a little about yourself.
Well, Kelly, I got a boy's name. We're not in Ireland, so it doesn't count, but I'm a financial advisor. I work for a company called Fundex. My trade name is Blue Chip Advice. My website is bluechipadvice.com. That's just where clients log in to see their stuff, hopefully go up. In terms of my background, I happen to have a degree in finance, merely a coincidence, and I've been doing this for, this will be my 26th year as a self-employed, independent, mercenary, financial planner, advisor type of person, which simply means that I don't work for a bank or any other institution that creates product. I can deal with everybody's product, and I'm not incentivized to do so in a biased manner, which is often what you find when your advisor's business card happens to match up with the investments on your statement. They're often incentivized to do that or disincentivized not to do it. So for me, being independent was very important. Also working from home, maintaining a home-based business was something that I've done from go almost. When I first started as a snot-nosed kid right out of school and looked like I was 10. And when I met Doug, I probably looked like I was 15, and he still took a chance on me. So
that's cool. So let's jump into that a little bit about the difference between, I guess, what you do and a bank does, and I guess maybe break down, how do the fees work? Like do I pay a bank to take my money? Do I pay you to take how does that work?
Yeah. So there's a lot there. In terms of the difference between me and a financial advisor in a bank, a financial advisor typically in a bank, not exclusively, but most times in a branch setting, when you meet a financial advisor, they were previously a loans officer and one day hope to be the branch manager, the regional manager. It's a stepping stone generally, not always. There are people who are career financial advisors in branches. It's just not atypical. So oftentimes you're dealing with revolving people throughout your financial career, if you're even dealing with the same bank. If that's not the case, then you might be lucky because you have someone, hopefully good or bad, but make no mistake, they still work for that bank. They may or may not have your best interest at heart within the parameters of their employer's instructions. So in my case, I'm a fiduciary, which means I have to put my client's needs ahead of my own legally. That was something I did prior to being called a fiduciary. And I'm assuming it's the same for financial advisors in the bank. But at the very least, you're looking at a limited product scope of what they're interested in selling, often because they're biased by their employers also being the manufacturers of those products. And or you're dealing with someone who has a limited amount of time in that role, and therefore their knowledge cannot nearly be as vast as if they've been doing it forever. And also their eyes on a different job. And if you get a great one, their chances are going to be promoted even faster. And you're going to have to constantly be re-explaining yourself to a new financial advisor. So the analogy I use often with people is it's like a softball team. So I'm not the New York Yankees shortstop by any means. But if me and Doug were on a softball team together and we played shortstop and second base, and I had an opportunity to bring Derek Jeter in, I'd kick Doug off the team or kick myself off the team, and we'd be watching Derek play baseball. Now, in this analogy, I'm no Derek Jeter compared to Doug and I on a softball team versus the bank, but I have been doing it for 2.5 decades. My knowledge base is quite vast. and it spans all kinds of topics that may or may not be relevant to clients as they move through their financial lifetimes, whether they're incorporated, not incorporated, sole proprietors, have businesses, want to save for education or disability savings, or buy or finance their car or lease, or they want to know which kind of mortgage to get. My knowledge regarding taxation as well is very deep also, because I've been doing this for so long. In terms of the fees that you pay, at the branch level, it varies. All the fees that you can pay in this industry there's multiple things. You can pay a front end fee to invest your money. You can pay a back end fee where the fund company or the place that's invested the money for you pays a commission to the advisor and his company. And then you're on a schedule which disappears over typically 6 years. You can have trustee fees to manage self-directed RSPs. You can have brokerage fees where your advisor or you call your advisor and we make some changes and you're charged on a transaction basis. You can also run into fees where there's managing the account fee or the management expense ratio of a particular investment fund. So depending upon how your advisor structures their business and how they're allowed to structure their business, whether they're truly independent or not, can vary greatly as to which type of fees you're exposed to and which type of fees you should avoid. Not all of which, unfortunately, are mandated by the government to be fully explained and exposed to clients. So oftentimes you're relying upon the good nature of whoever you deal with, or more importantly, their betters, their masters, and the company they work for in disclosing these fees and transaction costs. So in my case, it's very stripped down and it's very different than you'll see in most places. But in my opinion, it's the way it should be. I participate as clients participate. The more money I manage, the more money I make. I have no transaction fees, no in or out fees, no brokerage fees, nothing surprising. The more money you have, the more money I manage, the more clients I have, the more money I manage, the more money I make. If we all need to be on the same side of the table.
That makes sense.
That's a long run-on sentence, and I apologize for it.
That's good. And Kelly, I want to jump back on something that you said that kind of resonates with me was, we met. I was employed in a corporate job, making decent income, had a pension, was contributing, all that kind of stuff. And then I left that in late 2010. Now I don't have that T4 income. I'm self-employed. So I'm walking away from another corporate job, reinvested that with you. When I look back over the last 10 years, there's been some great years. Mm-hmm. You've helped me with that based on, what we're talking about here, financial advisory and stuff. And then there's been some tough years, right? So, and you've helped me with that and we've talked and stuff like that. So, I think it's the diversity and for me, it's the long-term relationship. I didn't have to go back to a bank and re-explain, oh yeah, here's where I was. And you kind of knew where I were. You were with me through my whole journey, good, bad, ugly. There was some great times and there was some rough periods there, but, I was always able to get through it and bounce back. And you were in some ways a big part of that too, right?
Awesome. That's really gratifying to hear. Don't always get this feedback.
To the point where I've even sent my kids to you and said, man, Kelly will take care of you, right? So
we get all the Doug's progeny.
Yeah. And even my daughter, Michaela, we talk about the bank. I mean, I'm not here to bash on banks, but she worked pretty hard for a couple summers full time and, banked up. She was good with her money. She banked up quite a bit of money, went to school, paid for that. And, she's sitting on a nice little nest egg, whatever she was, 20, 21 years old. She gets a call from the bank. She comes in. It wasn't even her branch. Gets a call, comes in, and the guy sells her a GIC and took almost all the money out and locked it into a 2-year GIC.
Yeah.
And the next month, she's moving to Ottawa to start a full-time job. Mm-hmm. And we're sitting down and doing budgeting and stuff. And I said, so you got this money and you can do Kelly. She goes, I don't have any money left. I'm like, what?
Yeah.
He said, yeah. She told me the story. That was on a weekend. So on Monday, I marched her back into the bank and we got the money back. And it was like, never asked her where she was in her life. Never asked her why she had all that money, where it all came from. There was just, all it was, again, I don't know what he made on a GIC, but, maybe going through a Rolodex.
Anything. Yeah, I doubt he made anything, Doug. I think moreover, he was just following his marching orders. Yeah. And when you have a certain amount of money floating around in a bank account, you hit a list and there's people who call that list. And the best product the bank ever had is a GIC because they lock your money up, barring death or divorce, and they lock it up at a low interest rate and they lend it back to you and others at higher interest rates over and over again because they only require 10% reserves. So in Canada, they actually lend that dollar 9 times and they can borrow it for next to nothing. They don't lend it for next to nothing though. That's why we buy the bank stock. And in this case, if we want to buy stocks, we don't necessarily buy bank stocks because there's a whole big world out there. So it's better usually to own than to loan to these companies, but not exclusively. It just depends.
Yeah.
So yeah, they got a hold of her and they did what was best for the bank.
And it was crazy because when we went back into the bank, we couldn't even see the same guy again. Oh,
Yeah,
he's
he was
busy. We were there on a Monday. I took her in on first thing Monday,
Yeah.
and we couldn't even see him until Friday. And she was leaving for Ottawa, I think,
Yeah.
like that week or whenever it was. Like, so we ended up going back to the Riverview branch
Yeah.
where we ended up opening her account as a kid, as a student. And I
Yeah.
walked in there and I just said, we need to speak to somebody now. And we talked to the gal and explained the situation, and they gave her all the money back. It was
That's really not the story I always hear.
yeah.
So they must have liked you or been afraid of you, because
I was pretty persistent. I wasn't
you
taking
don't usually get them to cooperate.
Yeah.
It's like kicking a boulder. No, we got your money. Haha. Not always, but that's pretty rare.
Yeah. All right. So let's jump off into. I've got a couple more questions here for you.
Sure.
So, one of the things I wanted, I sent you a list here, but the notice of assessment. Let's just talk about what that contribution number is. Like, where does that come from? And explain to us a little bit about why CRA tells us how much we can put away.
Sure. That's a good question. I can't tell you why the government keeps strings on us. That's a larger conversation, but I can tell you the math with which they do it. So as people who work in Canada or Canadian residents working globally and earning and paying taxes in Canada, you're eligible for 18% of all previously earned income in your lifetime to build up a fictitious limit called an RRSP limit. TFSAs are secondary because they're fixed based on the year of contribution, not by any means your success in terms of income. So RRSPs are 18% of everything you've ever earned in your life, less what you've put in RRSPs, and also less what was contributed for you in pensions if you were lucky enough to be in a job that contributed into a pension for you. So an example would be, sorry,
so that
go
would
ahead.
be the employer's portion, right?
Well,
Like
no,
a matching.
everybody's portion.
Okay.
So like your pension adjustment is a number that's on your T4 if you participate in a pension. And I'll give you an example. Let's say you have a $100,000 income on a T4, and that earns you $18,000, 18% of your previous year's income in a future contribution for the next tax year or any tax year in the future. But on your T4, there's a $12,000 pension adjustment. Well, in your calculation on the notice of assessment, you will see that math. You will see $100,000 income, 18%, 18,000, less pension adjustment of 12. Your RRSP limit for next year is $6,000. So you will see that adjustment being made for you. Also in there would be any contributions that you made to erode that limit as well. And of course, any previous limits that you earned from 18% and all of these dynamics from all previous years. So in a particular tax year, you can't go over your limit. If you go over by more than 3,000, Revenue Canada gets upset and taxes you on the overage. They'll allow a small overcontribution, but the next year they'll warn you about it on your notice of assessment and say, oh, by the way, you got $3,000 or $2,000 or however many that you didn't claim that we want you to claim eventually. So we're just warning you that this is already kind of a credit for you with us. The reason for that is they don't want you to take $100,000, dump it in a tax sheltered account, and eventually erode that limit as it appears. You got to operate within the limits. If you go beyond them, they start taxing. I'm not certain if that answers what you mean.
It does. I guess I'm also trying to understand it, because it's almost like they're saying you can, if you made $100,000, here's your limit of what you can put away, which is a tax deferral, right? But I want to tax you on the rest.
Are you kidding me, Doug? They're going to tax you on that too later. Like,
yeah, sooner or later.
The government taxes you when you make it.
Yeah.
They tax you when you invest it, and then they tax you when they spend it, and then they tax the guy whose product you bought spending it. This is a good scheme. It's a very good scheme.
It's a good
We're in the
scheme.
wrong business.
Yeah, and it's legal too, right? So
it's legal because they say it is. It's my job to legally play the game with them and try to minimize that both while someone's accruing wealth and also minimize its effect as you spend that wealth later, ideally. With RRSPs, the accrual and the tax deduction and the reinvestment of that tax deduction is the best technique. With the spending of it, it's just controlling it relative to other incomes so that you can at least withdraw at a lower bracket than you achieved the refund on, plus the utility value of that refund over the years or decades reinvested makes a huge difference.
Okay.
And I'm probably encroaching upon other questions you're going to have, but this is where
okay.
my brain rolls
good.
around. I just don't stop talking.
So let's jumps into the next one. So I had a question from somebody the other day that says, I think I'm going to owe $2,000 in taxes.
Yep.
Should I buy an RSP? Like, what's that evaluation process? Like, I went through that with you last year, right?
Yep.
And we can talk about that in a little more detail if we want to, but what's the rationale? If somebody owes $2,000 in taxes, how much do they need to invest to wipe that out?
Yep.
But what are the questions? Like, what's the evaluation process around this?
So the first thing, and this is something I talk about all the time, the first thing is people need to understand how taxes work in Canada. We have a tiered tax system. So the first about $14,000 that non-disabled people under age 65 make, and the reason I say those things, if you're disabled or over age 65 or both, you get larger exemptions. You don't pay any tax. That's why you tend to see kids with summer jobs not paying tax. So the first 13,800 or so federally, you're not paying anything. After that, and it goes up in increments, and there's a bunch of them. There's 7 or 8 different brackets, all the way up to past $250,000. So the first bracket, let's say in New Brunswick, for instance, is a 26% bracket from $13,800 to about $42,000. That person in that bracket might pay 25, 26% tax. So the answer to that question, how much tax deferral or tax deductible investments rather should I have to eliminate a $2,000 indebtedness, is totally dependent upon which marginal bracket you exist in at your highest level. Because RRSPs are top-down deductions, which are more powerful, because if you make $300,000 a year in New Brunswick, it's a 53% refund rate. So a person with a $2,000 indebtedness would have to put in, say, $3,800 in order to eliminate that indebtedness. But a person in a 26% bracket who makes $40,000 a year is going to have to put in much, much more to get back the same refund rate. Why? Because they didn't pay the same marginal rate of taxation. So that answer is custom. And the question that I usually bring people to is, the refund or tax liability really relevant? If you want to do an investment of $1,000 in an RSP and you're in a 30% tax bracket, it's worth $300 to you. Whether that reduces how much you owe, increases what you get as a refund, or a hybrid between the two, it's still worth $300. So reaching that zero refund as a goal is an arbitrary goal, because if you went over that, you'd get back as many dollars per dollar of effort in refund. So it's more about planning for, what is my ultimate goal with this money? So should I invest more money in RSPs and do whatever it is I'm going to do with that refund, reinvest or use it for other things, because I'm trying to reach a broader financial goal? In other words, our tax investing and our investing in general should not be reactionary to a tax bill. That by no means brings you to an outcome in retirement that is satisfactory. It's just a reaction to whatever you were under taxed throughout the year. So it should be a side effect that we address the tax bill and the refund status, but it should be secondary to the fact that you're investing for a larger goal. And the outcome of that investment likely will be reduction in tax liability or increase in refund. Do you see what I mean?
Yeah,
it's more of a cart before the horse scenario if you're worried only about the refund. Good question, but I often take that to a deeper place with clients as an answer, because I think that it's a great starting point, but not the point.
So the next thing is, I know what your answer is going to be, but for me to borrow money to invest with you,
yeah,
to pay that tax bill down is like, doesn't make sense at all, does it?
People do that. People get RRSP loans, and I'm not a huge fan of the gun to your head philosophy of investing. In other words, hey, let's go borrow $25,000. I'm going to get a $10,000 refund. I'm going to pay that $15,000 over the next 2 years. Gun to my head. Yes, interest rates are good. And yes, that's an individual calculation for each person, whether they should use borrowed funds for any form of investing. Moreover, one of the strategies that I try to get people to do is invest throughout the year, so it's not so cumbersome at tax time. Create that initial refund, especially if you're online with your taxes. Now, for home-based businesses, it's a little different, but if you have a T4, invest throughout the year, generate that refund. Then you sit down in January and February and say, look, I've got a $5,000 refund coming at me. It's going to come at me 3 weeks after I file my taxes. What is my plan with that? If your plan is to reinvest it, great. You can throw it in April, and 12 months later, you'll get another refund on the $5,000. And then you could throw that in April, and 24 months later, you'll get a refund on that. And you could throw that in April, and 36 months later, you'll get a refund on that. Or you can sit down in January and February and say, look, I'm in a 40% marginal bracket. I'm going to get $5,000. I would like 1,000 of it to buy myself a beautiful lawn chair, and I'm going to take 4 of it and reinvest it. But I'm not going to wait to April and then 12 months, 24 months, and 36 months to get my gravy off of that investment. I'm going to do it now utilizing a loan or a line of credit, and I'm just going to do the math. So I say if you're going to get $5,000 back and 1,000 is going to be allocated to a lawn chair and 4,000 is going to be reinvested, then prior to the March 1st deadline, go borrow, and you can figure this number out using a tax program. But let's say for argument's sake, borrow $7,000. So, sorry, borrow $3,000. So now you're in a position where your refund is now going to be on 7,000, or sorry, on your, it's going to increase by the additional 7,000, which is going to give you enough money back to pay off the short-term loan of 4,000 that you were dedicating. So your 4 is going to turn into 7, and you're going to get back $7,200 plus the 1,000 for the lawn chair. Now, that may seem convoluted because I'm not doing the math for a specific person in an actual tax bracket, but you can play the game and invest the money a month before the refund prior to the deadline. And in essence, what you're doing is investing the refund over multiple years, a month before the first one. And instead of having a snowball rolling down the hill, we're getting a brick of snow right away. And money invested longer tends to be more powerful. So that's a way for someone to dedicate that refund or magnify that refund in a safe way to use leveraging. No gun to the head on a loan payment because your loan will be fully satisfied by the increased refund. Now, I don't expect anybody to reverse engineer that. That's a larger conversation.
And that makes a lot of sense. And that's tax and financial planning, right?
It is. And it's a tool.
No.
It's not a tool for everyone.
No, but it also lends into what I talk about around the home business thing is, don't leave your home business expenses and your tax write-offs and stuff till now in an envelope or a bag. These are the things that you should be doing every month at the end of the month. You should know by the time December 31st rolls around, sort of where you sit in your business. Certainly. And then what you're talking about, that part kicks in and you kind of got a good snapshot of what your financial pay, because you could have a T4 income plus a side business.
Sure.
Being able to put those two together to see what that's going to net out.
Yeah.
As a refund or if you owe or whatever, and you have a better, rather than waiting until the end of February or early March to figure it out.
Well, if you want to do anything about your previous year's income from a business point of view, December 31st, unless you're incorporated, is the end of the game. Yeah. If you want to do anything about your personal income, you have till March 1st or February 29th in a leap year. And that's just doing a simple RSP. And if you're right, Doug, if you don't plan throughout the year, it becomes a last minute, last ditch effort. And you tend to get a last minute, last ditch result. If you can do the tax planning throughout the year, and I have multiple clients that do this throughout the year, they'll do their RSPs, they'll do their tax deductions, they send their kids to daycare, they have their write-offs, they have whatever, it generates a base refund that they can calculate utilizing their T4 or their last pay stub. And then we can sit down in the middle of February and figure it out. Okay, you've got $5,000 coming, and at your tax rate, that means we could do a $9,000 RRSP at the last minute. And where are we going to get that money? Well, we're going to have to get it from a loan. So you do the 9 and it gives you back $4,200. You add it to the 5 you're already going to get, it pays off your $9,000 loan plus interest 3 weeks later. That just took and made your effective refund rate not 40%, but 75%, because you've done, in essence, you've gone and thrown in multiple years refunds all at once. So instead of putting, let's use a simple example. If you take 10,000 and you're at a 50% rate and you drop it in an RSP, you get $5,000 back. If you do the same thing because you know you're going to get the $5,000 back, you could do another $10,000 and get another $5,000 back, and your effective refund rate is 100%, because you now have turned your $10,000 investment into a $20,000 investment, and utilizing the refund you generated from the first 10 and the loan on the second 10 paid off 3 weeks later. Now, later in life, when you take that money out of an RSP, you're not going to be at a 100% tax rate. That would be more criminal than is allowed. So even if you're at a 53% tax bracket at that point, which is less likely because working we tend to make more, but even if your bracket is the same, you're still only going to be paying tax at half the effective refund and reinvestment rate that you acquired by doing the loan. But that's not a gun to your head loan. And that's the difference between a short-term one that's paid off with a lump sum refund versus, say, a long multi-year RSP loan that you have to keep paying for. And that was probably a better example because it was cleaner. Sorry. Edit out my last one.
No, it's good. And I know that it's a lot of information for a lot of people. They're going to have to hit replay and watch this one again.
That's okay.
And I like to try to
slow motion. I look funny.
I like to try to keep these around 30 minutes because I know it's just a lot of content and stuff. So
sure.
when you say the gun to the head, like for me, I look at it and I almost look at it like one of the things that I talk a lot about is tax season. Like this is the time of year we only really think about our taxes and our T4s and our situation. Like, is the RRSP business designed around that too? Like it's sort of the temperature goes up this time of year and everyone's trying to get people to buy them, and you know what I mean? And the clock's ticking and it's at a deadline, right? Like,
so if you harken back to the days when you might have hung out in a club and 2 a.m. is approaching, things got a little more hectic.
We filled the table with drinks.
Before them lights come on, people started moving.
Yeah.
The molecules started reacting to going home alone.
Yeah.
Our RRSPs are no different. We have a deadline, and I think human nature is such that we only react at 1:45. We pound back whatever, and we go looking.
Yeah.
Or we flee, whichever. And it is better to work that room the whole night. It is better to understand your position. And that's why I said earlier about people reacting to a tax liability versus people investing as a plan. And the result of that is less of a tax liability, or even in my example about using short-term lines of credit, for instance, no tax liability and magnifying that refund reinvestment rate up from already damaging marginal rates. That's a strategy that doubles, in my example, the efforts that a person puts in place from their own pocket on the financial assistance of Revenue Canada. And when does that ever happen? Yeah. So it's better to be that guy who's there early, understands the room, knows how to pace himself or herself, and plans accordingly than to panic at RRSP time. And yeah, there's a ton of advertising around it because banks are trying to get people in at the last minute to make impulse purchases, probably like what happened to your daughter. And then once they get you in an impulse situation, they can lock into whatever product is best suited, hopefully for you, but oftentimes certainly for them as well.
Okay, that's interesting. So I had a question here, but I kind of lost it, but I'm trying to remember what it was.
I'm drifting you all over the place here, Doug.
Yeah, I know. It was a good one, but I get you saying stuff and it's like ping, ping.
Yeah.
So when it comes to, I guess, if you had somebody sitting here now going, holy crap, like, is it 2 a.m. or is it midnight?
Yeah. Right now,
we're days away from
it's 1 minute to 2.
Yeah, in your world.
The deadline is Monday, March 1st.
Yeah. So it's okay. So this conversation is more for, hey, it's the day after the 2 a.m. event, right? Like, let's start fresh and let's start moving forward, right?
The Friday night's done. Let's plan for Saturday.
Yeah.
Saturday is 2021 from March 2nd to March 1st of 2022. And as you pointed out, with business expenses, with financial decisions, if you wait until the last moment, you tend to get a panicked reaction. And if you're dealing with someone who's been in a job for 6 months and won't be there 6 months from now, who's really steering this boat? Last minute RRSP purchasers who are buying something when really it should be an integrated part of their financial plan, or the advisor who will next year be the branch manager?
Yeah.
That's up to you to decide. But if you don't seek out the right type of advice, get passionate about it, have these conversations as you and I have had for nearly 2 decades, then I can't psychically implant this information in you. That's torture. I need to see interest. I need to see responsiveness. I need to see inquiry. And I will feed that with knowledge, and then you will feed it with behavior, and then the results speak for themselves.
Okay. And I guess this is this how the rich get richer? Like, you look at a lot of these big, let's call it the rich society. They say, oh, they don't pay taxes and they don't do this. Like, these are part of the strategies, right?
Well, there's no legal way to earn income in Canada and not pay tax. What Donald Trump does in the States is beyond me. There's been some scandals in the years past about extremely rich people hiding their money offshore in Canada. That's different than what people listening to this are going to be participating in, and most of the time that's illegal. Doesn't mean they don't get away with it, but it's still illegal. So at the end of the day, the way to build wealth, in my opinion, and in the analogy that I use, it's the study of geology. Geology is nothing without pressure and time. Diamonds are just coal, and oil is just old bones until you apply a great deal of pressure over a long period of time. If you apply more pressure, you can do so in a shorter amount of time, and vice versa. So the equation for building wealth is rate of return That depends on how you're invested, what type of stuff you're buying, whether you're risking the farm or playing it safe, or somewhere in between, something that gives you good returns, but not necessarily risks all your money. Rate of return is important, and that's something you discuss with your advisor, and you should discuss. Time, that's up to you. We can't do anything about starting last year. We can't do very much about starting between now and Monday, but going forward, you can do a lot. And the other factor is how much money. And how much money is a function of savings, interest, and I don't mean getting interest from an investment, but your interest in this topic. If you're interested in something, you'll put more effort in it. It's like my wife tries to get me to do CrossFit. I have no interest in it. That's funny. So I stay out of shape relative to her, but that's okay. It's a choice. I make it consciously. It's the same thing with investing. If you choose to only give it a small amount of your attention, you will likely get a small result. I promise you that the rich pay more attention to this, but it is not a daily thing. You put in place programs and philosophies and the right people to repeat the same behavior successfully over and over again. Over time, pressure and time creates wealth. Inside of that, you want to use tax deductions, tax-free savings accounts, tax deductions for your business, or whatever you can create. And if you line all these things up together, you get a beautiful result. If you're disjointed in your strategy and listening to 7 voices, you get a disjointed result. And I know I answer your questions way bigger than you want. I'm sorry, I could say so much more, but you're going to hit the delete button on me.
Well, Ben, you're wrapping it up here. I don't know what more you can say. So I don't know if you get any, I'm not seeing any comments or questions and anybody has. So I don't know if you got any last parting comments or any wisdom you want to give to people. And I guess along with that, Kelly, is like, I guess as far as March 2nd goes, if anyone in this group wanted to reach out and maybe talk about financial planning, or maybe they're dealing with a bank and they're, can I leave some information here for them to connect with you or send you an email?
Yeah, certainly. I'm licensed in almost every province in Canada. I have clients throughout the US and some elsewhere, which means I'm a licensed financial advisor, and I can certainly have a conversation with someone specific about their circumstance, no matter whether it's this week, next week, or whatever. The only thing I caution people on, just like I've said already, is try not to make a panicked result, but you have to start the process somewhere. And if it's not the right fit, then you keep looking for the right person to deal with. You should have certain baseline situations in place for them. And in my opinion, that means they should not represent a product line. They should not work for a company that represents a product line. It does not mean that they're all bad advisors, not by a long shot, but it does necessarily and for certain mean that they are either incentivized or disincentivized not to produce the same looking portfolios as their employer. And make no mistake, that's their employer, is their employer manufacturers. So that right away, look for someone independent, someone with a track record, someone maybe that you know or have been referred to, and that is not going anywhere anytime soon because they want to. In other words, this is not a stepping stone for a promotion. Then you get into the fee structure and stuff, and that's more detailed than you probably want to talk about. But absolutely, having a conversation at any point is a cool thing.
All right, cool. I got Pam in the group says, wow, amazing info.
Cool, Pam.
So it's cool. So hopefully we have.
Did you make up Pam? Is she a real person?
She's actually my sister.
That's a real person.
Yeah.
That's all good. I'm sure you'll get some questions as you replay this, and I'm happy to share any insight I can.
Yeah, I appreciate it, Kelly. So this recording will sit in the group, and hopefully we'll get lots of replays, and
right on.
People get home from work tonight as they're sitting down and trying to digest this. Probably one of those. It's probably one of those videos people are gonna have to watch a couple of times, right? So.
Well, I've got a few articles on my Facebook group too. I'm not very active on it. I just post articles that I think are relevant to people. But it's just bluechipadvice.com on Facebook, or Blue Chip Advice on Facebook.
Okay.
I don't even know how to find the thing. I just know it's on there. So you can track me down. I'm not very aggressive in chasing people around. I just exist, and my clients are my clients. So
what's the best way to get a hold of you? Your email address?
Yeah, email's good. It's kelly@bluechipadvice.com. I'm sure Doug will also post a link to that. That's probably the best way to just start a conversation. And then even with clients who aren't local, I have a remote account setup procedure utilizing Zoom or Google Meeting where I need certain documents, and we do everything by e-signature. So geography is not really relevant unless it's relevant to the person. And I'm happy to give the advice whether someone's a client or not. I'm happy to give them an analysis of what I think they should do based on their custom situation.
Perfect. All
right.
It's
free, so you don't got to pay for my time.
There you go. And he knows his stuff, as you could probably see in this video. So
yeah,
right on, Kelly. That was awesome. Thanks very much for joining me today.
My pleasure. Thanks, Doug and Pam.
All right.
See ya.
See you guys.